Welcome to Chit Chat Money. On this show, hosts Ryan Henderson and Brett Schaefer interview industry experts and riff on the world of investing. As a quick reminder, Chit Chat Money is a CCM Media Group podcast. Ryan and Brett are not financial advisors. Anything discussed on Chit Chat Money by Ryan or Brett or any other podcast guest is not formal advice or a recommendation. Now please enjoy this episode.
Welcome in. This is the Fundamental Analysis Show, our Sunday episode where we go over a stock and help you learn about it in 20 minutes. But before we get to Peloton, our company today, I'm going to throw it over to Ryan to talk about our friends at 7 Investing.
Oh, right. Yeah, we have our coupon code, CCM.
Promo code.
Promo? Yeah, whatever. But it's you get $10 off your first month, and it's normally $17. So you're getting all their picks dating back to whenever they started for literally $7. So it seems like a no-brainer, but I mean, that's from us and we get a kickback. So
yeah, we love.
Feel free to support us.
Yeah, if you want to support the show in any way and also get a quality product while you're doing it, you can go to 7 Investing and use the discount code CCM. But let's get to the show. We're talking Peloton. Ryan, do you want to introduce the company?
Yeah, so I feel like most people know who Peloton is or what Peloton does, but they're an exercise equipment and media company. They describe themselves as the world's largest interactive fitness platform. So basically they have two fitness hardwares. Well, I guess there's different iterations of both now, but they have the bike and the treadmill. And then the bike, if you've never seen this, it's it's a stationary bike and it has what looks like an iPad on the face of it so that you can watch classes on it. And the bike costs around $2,000. I think it's like $1,890 or something like that. And you can finance the bike purchase over 39 months with 0% interest. And the classes cost around $39 a month. So the classes are more of a subscription and you get like virtual interactive classes. There's other people that are taking the classes at the same time. You can see how well you've done. It's like actually a pretty competitive atmosphere. It feels like I don't know, like a huge cycling class if you've ever done that.
Yeah, there's a big community aspect to it.
Right. And then the treadmill, I believe, is similar, but the bike's much more popular.
Bike's got to be 90% plus of the revenue. Yeah.
And then as far as history goes, in 2011, John Foley was an executive at Barnes & Noble, and he invited his former colleague, Tom Cortese, or I think it's maybe Cortese, over for dinner, and he pitched in the idea of what Peloton would be. The two agreed that some sort of bike with a screen for virtual classes would be a good idea, so they got $400,000 in seed funding from a few angel investors. That's not a lot of money, FYI.
For a company like this, no.
Yeah, and over the next year, they built a prototype with a few other co-founders. So all they had was one prototype, a name, and a few guys. And they ended up building up this business, and they had a lot of trouble getting investors because no one liked the idea of just a hardware business, which was just a cycling class at home. And that's what investors saw it as. Little did they know it would become the business that it's become today. But because of them having so much trouble getting funding, John Foley has roughly 30% of the business still. He owns that.
Wow.
And the other executives altogether, I think they make up like 58% of all the voting shares.
Wow, that's a lot.
Yeah, it's huge.
It's big because, I mean, they're going to be, if the company works out, they're going to be very, very rich. And it's also good because they have the incentive to align themselves with shareholders.
Yeah, and they were not, so they weren't very diluted down prior to going public. And I might be getting... I know John Foley had 30% of the voting shares.
Okay. So there might be a dual class.
There is a dual class, but it said like combined total voting power was 30%.
Okay, that makes sense. And the reason people doubted them so much is because typically hardware businesses have trouble, and the only one that's really had success over the long term is Apple. But in reality, people compare Peloton to Apple a lot, where it's like, well, it's not that much different, but the brand I guess matters a ton, and they're able to beat the stereotype of hardware businesses being bad. But I'll get into the valuation next. EV, or enterprise value, is $27.8 billion as the time of recording. We understand it's been a volatile week, so really check up on what the enterprise value or market cap is trading at currently. It could be a few billion different by the time you hear this. Their ticker is PTON. EV to sales 11.8. No dividend, no buybacks. They're in full growth mode. EV to gross profit is 27. So expensive, but not crazy, as what I'd classify it as. If we look at the earnings that Ryan will get into, you can see that they probably deserve a premium valuation. How much? An investor has to decide. Margin adjusted EV to sales, which is what we do, where we take EV divided by gross margin and sales growth. That is 11.8, which is really low and driven by the trailing sales growth being super high, up in the triple digits. And that's likely not going to be repeatable. But again, the high revenue growth could really help them get to a sustainable valuation quickly. It's not a guarantee. That's the thing.
Yeah, I think some people look at the triple digit revenue or top line growth and think it's going to stay that way forever. It obviously can't. So that doesn't make it a bad investment just because growth slows.
You just have to expect it to come down to the double digits eventually.
But I'll get into the earnings then. For the first quarter of 2021, revenue was $758 million, up 232% year over year. 79% of that revenue is connected fitness, so that's the purchases of the bike, and then 21% is subscription revenue. This quarter, they had 77.8 million workouts, so amount of people that worked out. No, sorry, not amount of people, amount of workouts done by their subscribers.
That's not a financial metric. That's just usage or whatever.
And that was up 306% year over year. So it's kind of showing that people are spending more time on the platform. And then they had 1.3 million connected fitness subscriptions, up 137% year over year, 43.4% gross margins, although subscription gross margin is 58.5%. I think the goal is that subscriptions start to make up more as Peloton gets later onto their life cycle. But obviously, even if people are subscribing to it, if they are doing really, really well and selling more bikes, it's hard for subscriptions to make up a majority of the top line.
I think, they just want them to both grow at the same time right now.
Yeah. And then they had 69.3 million in net income, 119 million in adjusted EBITDA, 2 billion in cash and cash equivalents. And then their operating cash flow margin was 41.1%. That's a pretty interesting. That's an appealing number.
I think there must have been some one-time things. I tweeted out that they had 312 million operating cash flow. Looking at that enterprise value, it doesn't seem crazy, but there's some things on there that likely attributed to that happening, whether it was inventory, something like that wouldn't be repeatable. So that's a good number, but we'll see what happens over a trailing 12-month period or, the next few quarters here. And then one thing I forgot to mention on the balance sheet is that they have no big liabilities outside of their long-term lease liabilities. And then some other liabilities are deferred revenue. But if you think that people are going to continue to subscribe and keep their bikes and not send them back, they should be fine.
Did you check any of the stock-based compensation numbers?
Not bad. This quarter, it was 29 million.
Okay.
So not crazy, but not zero. It's just something, obviously, with a company like this to watch out for. Okay, welcome back. First up now is digging trenches. What do you think here? Does Peloton have any sort of moat, any competitive advantages?
I'm going to go, and this might blow your mind, I'm going to go with a 3. A full-blown moat. I think it's incredibly sticky. I think the community aspect has driven people to stay on, and anyone that I know that has a Peloton, we talked with Richard Chu last week, they love it, which usually when you have raving customers, it builds some sort of retention and stickiness. I mean, people have tried to launch competitors, but there's a massive network effect with Peloton's business. As influencers come to the business, as more people flock to being a Peloton member, the next one, it's incrementally the value of joining is higher.
Yeah, and then maybe before the pandemic, people would have thought, all right, there's room for a competitor to step in. But now with them just accelerating their business so much, they may have hit escape velocity where not even someone like a big tech company, unless they invest billions and billions of dollars, they're not going to be able to compete with Peloton. Now, does that make you still have to take into account the valuation, things like that. But does the business have a strong moat? I'd agree, maybe 2.5, but it's definitely high, and that's one of the reasons people are very, very bullish on Peloton.
What are you looking at for further reading?
How they plan to incorporate non-cardio activities. It seems like a tough problem to solve. Do they want to steal lifters from the gym, or are they just trying to add people who didn't go to the gym beforehand? Is that the market they're going after? You can't implement a squat rack. You can't have a dumbbell set in someone's home. You have to get a little bit innovative on there, some sort of way to solve problems. Are they going to have bands or all the different types of things? So it's kind of tough to acquire those type of people. But if they can get them on the subscription,
deal.
Software, whatever it is, that's a whole nother market to go after. That's just as big as the cardio one.
Yeah, and I think that's sort of what Mirror, the company that Lululemon acquired, is going after. And maybe I'm wrong, but their Bike Plus, I believe the screen can turn. So I think you can kind of use that as sort of like a mirror type thing, where if you're doing at-home band workouts, something like that, maybe they move into that market. Maybe they already have. I haven't really looked into that, but that's definitely something to look forward to. And then for me, I'm looking at the success of the upgrade cycle. So like I said, they recently launched their Bike Plus. So it's about $500 more than the original bike. And I'd love to see in coming quarters on the conference call if they mention how successful this has been. Because if we're seeing a lot of people that originally owned the normal bike and are upgrading to the Bike Plus, I think the Apple comparisons are warranted.
They're actually warranted, because it's kind of like the iPhone Pro thing. And even though maybe someone comes out with a technically superior product than Peloton, like a Samsung, the brand value of the Apple or Peloton, actually, people are like, oh, brand value, oh, it's just hardware with an iPad. Apple, that's Apple's entire business. So
yeah, and it's, maybe I'm wrong, but it is the most expensive business in the world, or most valuable, right?
One of the three. Yeah. It changes all the time.
Future growth opportunities. What do you have?
Okay, I'm sticking with the same theme, strength training. They said strength workout usage is up 500% year over year, and it will be interesting to see how they work around the equipment. Like I said, no squat racks, no machines, no full dumbbell racks. But, with the video offerings, with the mirror things, there's ways they can go about it. They can attract people to get these digital memberships without having to get the bikes or the hardware. Because I know, at least my style of working out and your style of working out, we like to do more of the resistance training type things.
Yeah.
And if you could have that value proposition for people like that, I would consider signing up. And I know there's probably millions of other people out there that would.
Yeah, I agree. And I think that's sort of going after all those 30 to 40-year-olds that signed up for P90X, whatever it was, 10 years ago, and sort of replacing that. And some people make the argument that it's like, well, what about the heavy lifters? And I'm like, they're never going to do this.
And in reality, there's not that many of them.
Right. And maybe they incorporate some form of cardio into it and they could get a Peloton too, but they're like, that's not who Peloton is going after.
Yeah.
So it doesn't really matter.
Yep.
And then for me, I'm looking at they're starting to partner with influencers. So this morning they just signed a partnership with Beyonce, and so we're recording this way early. I think it's a week early.
Yeah.
So
4 trading days. Yeah.
It's probably been a week since this was announced, but on their investor relations announcements, they stated Peloton, the world's leading interactive fitness platform. Which, are you referring to yourself in the third person?
Yeah. No, companies do that. It is strange. But.
And Grammy Award-winning global entertainer and entrepreneur Beyonce today announced a broad multi-year partnership rooted in the celebration of music, a central component of the Peloton Class experience and pro-social initiatives. And I'm not sure exactly what the partnership details because they said it was broad, and I'm not sure if she's teaching classes, but she has been a member for a few years. And I think the more people that you can sign on that are influencers, it starts to become a really expensive social media platform.
Yeah, sort of. The integration with Instagram stuff, people can easily see that adjacency. But I think in reality, Peloton has a lot of money. They can give Beyonce a lot of money, and then that marketing spend, if she is able to acquire acquire members, that's great. It's all worthwhile.
And wouldn't you feel more inclined, I guess maybe not Beyonce for us, but if you're competing against, wasn't Rory McIlroy on there or something?
Yeah, I see. I think Jeff Mack tweets about it, how he competes with Rory McIlroy because he's a golfer and he invests in Peloton.
Doesn't it just make you kind of want to join the platform?
Yeah, if I was a biker or a spin class person, I see no reason why I wouldn't be on Peloton.
Okay. Highlights and lowlights. What do you have?
Okay, the rapid growth that they've gotten here has shown that they can achieve operating leverage. Once they get to scale, it feels realistic. They could get to 20% free cash flow margin. I know you had the gross margin currently in the low 40s, but if digital members become a larger percentage of revenue, that should inch closer to 50% over time. If connected subs can grow up to 25 million plus, that should be a lot of high margin revenue there, and there should be operating leverage to hopefully increase those margins. That's really what matters to an investor over time. Lowlights for me, CEO did lie about their profitability pre-IPO. He said we're surprisingly profitable, and then the S1 came out and they were hemorrhaging money at the time. So that was a red flag to me.
It's an internal metric.
Yeah, he could have been talking about their unit economics, but that does concern me a bit, although might have just been one slip up. Everyone can make a mistake. Another low light for me though is it's a very popular stock. I don't like to hopefully something I invest in becomes popular over time because it does well. I'm not too interested in something that has gone up 200%, although sometimes that's warranted. You got to balance those things out. And I'm not sure once gyms open up fully if they can still be operating cash flow positive. This boost may have just been a one-time It doesn't mean the business is bad, but it doesn't mean that profits are here to stay. In a normalized environment, I want to see if they can still generate those operating profits.
I will burst your bubble a little bit. Most gyms are open. And we are in Washington, which was a pretty locked down state. Some of them are like a little socially distanced, but most gyms are operational.
Okay, when gyms are normalized and everyone's
confident to go back.
Yeah, that's what I mean.
Yeah, I mean, my highlight is that when this vaccine news got announced, they got ripped apart. I don't think this is a stock or this is a business that customers run away from when COVID ends. I would say Zoom. Yeah. Like, there are plenty of companies that their shift to digital was temporary. I think Zoom is maybe one of those. I think we did hit peak Zoom during COVID, and we're still probably in peak Zoom. I would say Peloton is not one of those. I think the convenience, the customer enthusiasm for the product makes me feel like they're here to stay. And then the recurring revenue model the subscriptions over time, I assume, unless the hardware continues to sell at triple-digit growth rates, will start to make up more of the top line, making it obviously higher margin, so good operating leverage there.
And I guess another lowlight is the fact that the hardware, the hardware revenue may disappear slowly. They might not be getting growth from that, and that could slow down revenue substantially. That could scare investors. That's something that could happen.
Yeah, it's something there. I don't know. I feel like I'm reaching for lowlights with this business. So I guess the one that I have is a heavy portion of their management is from Barnes & Noble.
Maybe they learned their lesson.
Yeah, I mean, maybe you coming from a losing company might actually be more valuable than coming from a winning company because you've learned a lot of lessons on what to avoid. But
true.
I believe like 42% of the company is owned by Barnes & Noble's old CEO and then John Foley, who was an exec at Barnes & Noble. But I'm really reaching there. That's like all suspect.
Yeah, I guess you could say that churn may increase once, things get normalized. But that's just something to watch out for. I'm not confident that churn will increase. And if it even does slightly, it doesn't make the business bad.
Yeah. All right. More or less interested?
I'm definitely more interested, especially when the valuation has come down. Something to look at. Again, I worry about them being such an efficiently traded stock, although the consensus can lead to the 10% drop that possibly would have been unwarranted. But yeah, it being so popular does concern me, but there's no concerns about the business. I could see why a lot of people love this company, and the valuation, if you believe in the community aspect, if you believe in the competitive advantages, and if you believe in the software sales becoming larger over time and their ability to get to 25 million plus users, sounds good, like there's nothing wrong with that. And I'm definitely more interested.
Yeah, I totally agree. And I hate to make like short-term predictions, but I think they're going to blow Q4 or the Christmas season out of the water. Like,
if any inventory indicators are there, Yeah.
I mean, think about all the people that are buying this that are working, I don't know, for friends, family, that kind of thing. I've heard that a lot of people re-gift the bikes.
Really?
Which seems weird, but
don't want to be a re-gifter.
I know,
from
but
that Seinfeld episode. But
20 to 30% free cash flow margins on an EV to sales of 11.
Yeah.
But I mean, that's
potentially
right. I mean, that could be a huge. Right now, it's 40% operating cash flow margins. Obviously, that might have been a one-time flip.
Yeah.
But I don't know. I love the business.
Yeah. Let's see. I mean, another anecdotally, a lot of people are ordering Pelotons, and you see them in the FinTwit community. They're saying that the orders are not coming for another 3 months or so. You could barely get them in time for Christmas. So that's got to be a good thing, right?
Yeah, and I have heard the argument before that people are like, well, it's still a hardware business. And it's like, some of the hardware isn't a bad thing. Like, it might be naturally a little lower margin than software, but some of the best businesses of all time are a blend of hardware and software.
Yeah. And the hardware, you have to have a brand. I mean, Dell, nothing can happen there when something like that changes. But yeah, we're good to go. Anything else?
No, that's it.
Okay, that's going to do it for this episode. As always, remember to use our 7investing promo code CCM for $10 off your first month. Remember, we are not financial advisors. Anything we say on this show is not formal advice or recommendation. Give us any recommendations for new shows to do by emailing us at chitchatmoneypodcast@gmail.com, or if you're on Twitter, DM us at our Chit Chat Money feed. Those will be in the show notes as well. Thank you all for listening. We'll see you on our next episode.